So you brought it up. We got to get into it now. You're not just calling for an endless melt up or a bubble that just, has a correction that gets reflated and we keep going and the game goes on for 5, 10, 20 years. You're calling for a global bust. I'm going to let you describe what that looks like.
This is going to be bigger than anything we've experienced. I mean, this could be, I think, likely will be the biggest financial crisis in the history of the world.
Today, I have the privilege of welcoming the renowned macro strategist, David Hunter, onto the podcast. Now, he's got about 50 years of experience on Wall Street, and he's been right in a big way over the past couple of years. What I like about David is, he had the gusto to go long when everybody else was short. And in 2022, he called the melt up that we're all experiencing right now. The S&P was 3,500. He called for 6,000. People were laughing at him, making fun of him. Nobody's laughing anymore. And he's got some big updates for us today. Set the table for us, David. What do the markets have in store for us over the next few quarters? You were able to see something that very few people could see back then. What do you see today?
Yeah, thanks for having me on, Alex. I think we're, as I keep saying, there's still a pretty long runway ahead. You're seeing a lot of calls out there, I think, for people saying, this thing's getting close to an end. We've got to have at least some kind of a large correction, 20% correction or, 15% correction. And then others saying that, we're at the top. And all my work is still pointing to this having plenty of legs. And surprises me, as you said, I had a 6,000 target a little over 2 years ago. And I raised that from 6,000 to 7,000 range. I think early this year, I raised it to dropped to 6,000, said 7,000. In recent months, I raised that to 7,500 on the S&P. So to me, there's no reason to be bearish here. Yes, I'm getting a lot more people using the term melt up, talking about this thing, maybe going to 7,000. So a lot of my followers go, they know I'm a contrarian. They go, doesn't that concern you? Doesn't that mean we're close to the end? They're starting to sound like you. And I say they're there because of the momentum of the tape. They don't have the conviction. You get a setback, you get a little rollover, and you're going to see a lot of those people go the other way. So there's still plenty of skepticism. We all know valuations look high, so people are concerned that it doesn't have a lot of upside. Mm-hmm. But I do cross market work, which means I look at other markets as well as sectors within the stock market. And it still points to us having somewhere between 25 and 40% upside, depending on the index. So normal years, that'd be 2 years worth of returns at least. Mm-hmm. And maybe we get them in 3 months. But so we may be close in time, but that's a lot of money to leave on the table and say, I'm getting nervous and, I can't pick the top.
Yeah, let's talk about that for a minute, timing, because I know you kind of pushed back your timing a little bit. I think originally you were thinking like it was going to peak maybe end of this year or Q1. Now you're sort of looking at a peak as late as Q2 2025. Are you sort of sticking with that for now?
Yeah, anybody that has followed me for very long knows that the one criticism I get on the street constantly is that I'm constantly pushing the timing back. And I tell people my forecasts really aren't. There's no time to them. They're cycle calls. It's the market's going to determine when the cycle ends. Maybe I make the mistake, but I try to give some guidance as to what I'm thinking at the time of how fast it could happen. So, I'm always kind of 3 to 6 months out because, with that kind of distance to go, it's not going to happen in a month, or it certainly would be very unusual to have it happen in a month. So my timing is really just to say, at least at this point, we're coming up on the end of the year. I think you are going to have a year-end rally from here, and you could top out in the first quarter, but it doesn't have to top out in the first quarter. It could be the second quarter. So I really don't want people focused on time. As I say, my targets are really my forecast. The timing is going to be if we get consolidations. I'm not expecting any kind of a long consolidation between here and the top, but if we happen to get something that lasts a couple months, it just stretches the whole cycle out.
Right. What would have to happen for you to extend your target even further, say to 8,000 on the S&P or even higher? Could you envision a scenario like that?
Sure. I mean, I use the term melt up and have for a number of years, probably going back 5 years. And I didn't invent the term, but at the time I started using it, nobody was using it or very few were using it. Maybe there was another one or two people out there. And as I tell people, on my feed, I get this a lot. People act like melt up is something specific, like it's, and I go, it's just to describe that at the end of what I think is a 42-year secular bull market that started in 1982, that the likelihood is that the last piece of that, the last stage of that is going to go parabolic. So the melt up is really this parabolic melt up is what I think we're just entering. But we've really been in the melt up since the lows of October 23, and it just means the market's gotten steeper. We're getting more, we're getting an unusual amount of return in a fairly short period of time. So, yeah, I could certainly see this.
Yeah, I mean, like it's kind of reminding me of the late 90s, right, where the market is going up 30% year over year. Obviously, we know how that story ended. Are you gauging like to sort of time this? And I mean, looking at these tops, these targets, are you using sentiment? Are you using technical analysis? What fundamentals? Like, can you just give us a bit of an overview of kind of the metrics that you're...
I kind of shorthand it this way. I use fundamentals, kind of company fundamentals, fundamentals within the market, as well as macro fundamentals. So fundamentals and macro, I use technicals, nothing fancy, but, I do some technical analysis on it. And I use sentiment for sure as a contrarian. That's a very big piece. And then I use cross markets. And as I said, it's really just to be able to go underneath the surface of the market and look at other things. And if they confirm or give me some idea, for example, I'm looking for 400 on SMH, which is the semiconductor ETF. It's currently 240 something, 240 and change. So that's a big run from here, 60% or more, I think. But
in the next 6 months before the blow off top.
within the same, as I call pre-bust, within the same market top finish here. And so with that as upside, or if that's what several of the underlying sectors are telling me, is that there's plenty of room upside, it tells me that at the very least, my 7,500 is conservative. So I would not be surprised if it exceeds that. Now, at this point, I'm not, I get myself in trouble because then people want to know, well, how much more do you think can go beyond 75? I go, no, that's my forecast. I'm putting out what I really believe it can do, but it's not going to shock me if it goes beyond that.
And if something changes, I mean, you can update your stance at that point.
And that's what I've done. I've read, people will be critical and say, well, you've changed your targets. You were at 6,000. I go, that's what a good analyst does, is you get new information as you move along and you adjust to that. But I usually change my targets while the market's going down. I'm raising targets, January of, I don't know, it was this year. I think it was, probably was early this year when the market was selling off some, I was raising targets. So I try to do it well in advance. I'm not one of the good till reached type of analysts, but yeah, if the evidence is there that it needs to be raised, I'll raise it.
Yeah, I appreciate that. I mean, how does Trump play into all this? He is a generational figure, a generational political leader. And it's interesting, you talked about we're coming to the end of this 42-year cycle, and Trump has come in, and I think he has led to some of the euphoria that we're witnessing now in the markets. I mean, he's going to cut regulations, he's going to cut taxes. The sentiment, could not be more bullish in the U.S., particularly with the Republicans. Is there a chance that maybe he sort of fails to deliver? At some point, people realize, wait a second, my life is kind of the same. Some things are better, but do you think that could lead to potentially this, wait a second, S&P earnings are, at 35, what's going on here? And lead to the precipitous drop?
Yeah, for sure. I mean, if you go back to October, when the market really started moving up, it started sensing, I think there were plenty of internal indicators that Trump was going to win. So you were starting to get that built in before the election. And then the week of the election, we had a 5% run after it was clear he won. So definitely he's played a role in, Since then, it's moved higher to new highs. For sure, that's adding to what's going on. What people question me on is when I say, but it really wouldn't have mattered who was elected. I think we were going to go here anyway. I don't think his policies will be enacted before the top. In other words, he can't have a lot of influence on what's going to happen between now and whether it's March or April or somewhere in there. And what I do think next year, more likely than anything, is you're going to get the downside of his policies. If we're, if we're really going to hit the ground running on deportation, if we're going to see government waste taken on right away, a lot of those things will probably, in the early stages of the change in policy, cause some contraction. So if anything, he may contribute to softening next year, which I expect anyway. But for sure, his policies, looking out over the next 4 years, are very pro-capitalist, are very much, what we need in this country to rejuvenate the economy. So it does give me some hope. Probably know I have, not only a melt-up call, but a global bust call for the other side of this. And I'm not jumping ahead, but that is where I think his policy could alter my forecast. I'm not saying it does right now. I don't see anything happen. It's going to, but it's possible, particularly in the post-bust period, that the next cycle beyond the bust is really benefited by his policies.
So you brought it up. We got to get into it now. It's one of the things I like about your calls here. You're not just calling for an endless melt-up or a bubble that just, has a correction that gets reflated and we keep going and the game goes on for 5, 10, 20 years. You're calling for a global bust. I'm going to let you describe what that looks like.
Yeah, I use the term bust to differentiate it from 2008-9. In some ways, probably the easiest way to think about it is 2008-9 on steroids. So bigger than that. Not bigger in every way. I mean, in the U.S., I think subprime was, a factor. It's not going to be a factor this time. So you won't see, I think, the banking crisis we saw in the U.S. However, up your way and over in Europe and in Asia, I think we have more things, more excesses that can lead to a bigger unwind financially. So a bust, in my opinion, is basically something bigger than a normal recession, not as long as, by any means, not as long as a depression, certainly not the Great Depression. It happens pretty fast because it's mostly a deep recession combined with, in this case, I think what could be a very historic financial unwind, financial crisis and banking crisis across the globe. And it's driven, I come to this conclusion probably first and foremost because leverage is way beyond what it was in 2008-9. A lot of it is sovereign debt, so that may not be a factor this time around in a big way, but basically leverage, whether you call leverage in terms of debt, which I call leverage on the system, and leverage in terms of derivatives, which I call leverage on the markets. We've got quadrillions in notional value of derivatives, and we've got 320 trillion in debt, global debt. Anybody who went to business school learned that leverage works both ways. On the way up, it enhances returns or enhances what you're trying to do. On the way down, it really can exacerbate the pain. And so because I think we're coming to the end of this cycle, it's a cycle that's been in place for a long time. And, we had a short closing of the economy in 2020. So some people think we're in a new cycle, but basically I think we're in a cycle going back to 2009. And so it's been a long cycle. It's coming to an end. There's lots of excesses and you've got it very leveraged. When it unwinds, I think it's going to be painful.
That's when really the money printing started, right? After the great financial crisis, both, the Fed up here in Canada and Europe. Now, debt as it on its own, is deflationary, right? Like it weighs on growth typically, but it hasn't been an issue for all these years. What is going to trigger? Why is it suddenly going to become an issue?
Again, I use shorthand to kind of when people say, what causes this bust? And I go, basically it's that leverage, what I described, the massive leverage in debt and derivatives, combined with a fragile global economy caused by the pandemic. So in spite of the fact that we've recovered, and particularly in the U.S., it looks like, that's a long time in our past. Underneath the surface, there's still a lot of fragility that was brought about by that. some of the fragility is in the small business community. Some of it is in what we've been dealing with in terms of the supply chain and inflation and things like that. But basically, I think you have an economy that statistically looks like it's holding together pretty good. But when you get underneath and look at some of the individual components, you say, now it's not as healthy as in past times going into a recession. So you got that. And then thirdly, I think is a major policy error. And that policy error may be across the globe in terms of central bank policy error. I believe, and this will be proven in the future whether I'm right or not, but I believe that basically the central banks are making a mistake of fighting the last war being inflation, when in fact I think the risks right now are deflation. And so, yes, you get PPI today and people say, oh, it ticked up, we're not, and there's a whole narrative out there about reaccelerating of inflation, et cetera. And it's keeping the central bank, keeping the Fed certainly on, kind of the very, very reluctant to ease very aggressively. So, yes, we've cut rates. We cut rates 50 basis points in September and another quarter in November. And we'll probably get a cut next week of a quarter. So you've got a 100 basis point cut. What nobody's focused on is the fact that they're shrinking the balance sheet still.
We're down below $7 trillion. It's the lowest it's been since March of 2020. It's rolling off nicely. That it's $93 billion in November.
Well, nicely it depends on your perspective. Nicely, and that's really what's happening is people are very, they think it was a huge mistake to print all that money, right? I mean, and to have 0% interest rates for so long. So everybody wants to fix that. The problem is recessions are caused by central banks shrinking the money supply. That's really what causes recessions is money supply with lags, long and variable lags. But money supply is what enhances or shrinks demand. So we've taken $2 trillion off the balance sheet. Now it's $2 trillion off what was a very high balance sheet. We printed $5 trillion in 2020 and 21. So taking $2 of that 5 back, you say, well, yeah, but there's still plenty around. The problem is it's at the margin that things matter. So you've taken $2 trillion out. Step back and think about it. We've never in the U.S. history of the Federal Reserve, we've never shrunk the balance sheet by $2 trillion before, right? We never were here. I mean, the balance sheet in 2008 before the crisis was $875 billion, and then it grew by $3.5 trillion before the pandemic, and then grew by another $5 trillion. So I'm kind of playing games when I say we've never done that kind of shrinkage before, but really. Well, nobody, I don't know, well, maybe one or two economists out there that are more monetarist oriented do understand, but the majority of Wall Street thinks of easing in terms of interest rates. And rates are a piece of it, but so is money. And everybody's ignoring the fact that, and this is going on around the world, that money is being squeezed, And so at some point, we're not there yet. That's why I think we have still several months to go. But at some point in this next many months, I think you're going to start seeing that take a toll on demand and therefore take a toll on the economy.
Just looking at household debt, record all-time high, credit card debt, Q3 of 2024, record all-time high, 1.17 trillion from 760 billion in 21. So it's had a big move. And
that's part of that under the surface fragility is people are using their credit cards to pay for necessities at the lower end of our income scale. There's a have and a have not economy. So the haves, they've had the benefit of all-time highs in the stock market, all-time highs in real estate values. So their wealth is up nicely, and they're having a good time, and their incomes are good. There's a half of the population that's having to, barely get by, and many times using credit cards to buy groceries, et cetera. So that's some of the fragility that I speak of, that you're going to all of a sudden reach a point where that doesn't work anymore. You can't keep extending this thing,
and which is why the downturn you think will be so rough. I mean, I've got a theory that the Fed has to cut rates to deal with the interest on the national debt. Right? It's at about like 1.2 trillion. There's still 8 or 9 trillion that are short term in terms of that. 36 trillion like 8 or 9 trillion is rolling over relatively soon. It's constantly rolling over. It's short-term debt. They have to get that number down. Is that going to force them to lower rates no matter what, which is going to spur inflation?
Yeah, this is where I think, again, that's kind of a Wall Street, a lot on Wall Street look at it that way. I've spent, if you've followed me, you've probably seen me rail about this. I've spent many, many tweets talking about the fact that the Fed doesn't control rates. The bond market and bond market investors control rates. I'm not so worried about what the Fed's going to do in any given meeting. The trend will be down. The Fed's going to be cutting rates. But more importantly, the bond market, which is the aggregate of all information out there, is going to send rates lower because of the scenario I'm portraying, I'm presenting, which is that we are heading to, first of all, the trend of inflation is down, and ultimately, I think, into deflation in the bust. And secondly, the economy, despite, recently seeming to gain a little ground, is actually, weakening. What we had, another thing that complicates it is we had an election with the incumbent party doing an awful lot of government spending to, prop things up until we got to the election. That should fall by the wayside here as we enter the new year, even if Trump weren't the president. But I think with him, then again, we got 𝙃𝙊𝙉𝙉𝘼 and we got things going on. We're definitely going to see fiscal spending as a drag, not as a stimulus. All those things point to first half of next year. Rates are going to come down. Ultimately, I think you're going to see 3% within the next few months, maybe even 2.5%.
Wow, that's a huge drop from here, David.
Yeah, and it will be because, and I don't know which month it will be, but it will be because we recognize that inflation's not picking up. It's actually still rolling over or trending down. I think oil's headed for $60 and maybe below that in the next 6 months. So you're going to have things like that. Consumer spending, I think, is going to start falling off. So there'll be reasons why the Fed will get back on board. Everybody's right now, I would say the kind of common narrative out there is, we get a cut next week, and maybe we might get another cut in January, and then they're going to pause. And I think if you look at the futures, their basic Fed funds, I think they're basically still expecting a few cuts next year. And I heard a commentator today ask that question. Why aren't they starting to say, hey, with inflation up, the economy doing okay, why aren't they pulling away from those expectations? And I think in the law of large numbers, the markets are better predictors than economists themselves. And I do think it's recognized that ultimately we're moving towards a slower economy, not a faster one, and ultimately recession and ultimately a bust.
Let's talk about the bust. How long in duration and how steep would it be? I know you've got some values. Could you share them with us?
Yeah, I think bust probably is 12 to 18 months. If I were guessing, it's towards that 12, not the 18, but who knows? But to contrast it with a depression, obviously, which can last a decade or many years, this is going to be rather quick, kind of the length of a recession. I think the market will bottom before, many months, several months before the bottom of the bust. So it doesn't mean you're going to feel great, even if the market's turning back up. You may not feel good for another 9 or 12 months after that. So, it's not going to be straight down and then straight up. But I do think probably, let's say the bust starts by the middle of next year, it could be over by the end of 2026 or maybe even middle of 26.
And the cure is what Western central bankers always use as the cure: massive monetary stimulus, money printing. That's what's led us here. Ultimately, all that excess has kind of led to these overvalued markets and everything else. We're just going to go right back. Like, how much deleveraging can happen in those 12 to 18 months? And then we're just going to go right back to that playbook, which I agree with you. I mean, that is the way that it's going to go. But, how much deleveraging can happen in those 12 to 18 months? And how big is that stimulus going to have to be to get us out of it?
Yeah, what I think... where I think the narrative or the criticism is somewhat off base in terms of, not you, but basically the street's thinking on things, particularly Austrian thinking that it's all central bankers that have caused this. I view it more as an inevitability of the super cycle that, let's say we start, I I define a super cycle as that period between two depressions. So the 1930s being the last depression, the 2030s being the next one. This global bust is not a depression. 100-year basically period of time between the two depressions. As you come out of a depression, going back to the 1940s, you're coming out of an economy flat on its back. Debt's been involuntarily liquidated. So you're basically, there's low debt. There's lots of capacity because demand's been way down because of a depression, et cetera. And you had, in that case, you had a world war, so it got, you had something propping up coming out of there. But basically, you have had many economic cycles since the depression, right? And what happens is each successive cycle, you have excesses, and then you have to unwind some of those excesses, but you don't unwind them all, and then you go to higher highs on those excesses. So each cycle gets a little bit more extreme or has more excesses in it. And when you reach the end of a cycle, which tends to be 80 or 100 years, by then you're at the point where those excesses are just getting so extreme that what it takes to unwind them is also extreme. And it's kind of like, I don't know, I'm not a mathematician, I don't know what sine waves or what it is that describes it, but it's that, where it gets more, the volatility gets greater each time. Mm-hmm. And that's where I think we're at, that's why you can have what happened in 2008-9. And normally you'd say, well, we're not going to see another one of those for 50 years or 40 years because you just don't see it.
That's basically what Janet Yellen came out and said, I don't know, a couple of years ago. She said, we'll never see another crisis like this in our lifetime, right?
But the problem is that
gave me a chill.
Yeah, look at what we almost, I'd say 2008-9, we almost went over the cliff, almost saw what I describe as a bust. But they pulled us back from the cliff because the policymakers reacted in time, so that when the commercial paper market almost closed in 2008, fall of 2008, and it was rumored that GE was going to go under, and it was just going to, we were going to have a dominoing effect through the cascading effect. Mm-hmm. That we pulled back from that cliff just in time, and so we blew it back up, and more so than ever. As I said, we went from 800. The entire history of the Fed, going back to 1913, it's never been bigger than $875 billion. That was the size of the balance sheet. And then we blew it up to $9 trillion. So you can see that we're getting into it takes a lot more to pull us out of the problems that are created. And when we try to unwind the excesses, what it takes to get you back out on the other side is a lot more. And that's what I think we're going to see. Is we saw, $3.5 trillion coming out of 2009, coming out of 2020, we saw $5 trillion. I'm estimating that we're going to see something like $20 trillion out of the Fed this time. So
from the Fed?
Just from the Fed. So proportionally similar around the world. So 100 trillion, whatever it is. And when you say, well, Powell's saying he will not go back there. He's adamant that we're not going to use that playbook again. In fact, he wants to do away with QE or stay away from QE. That's easy to say until you're faced with a financial system that's breaking right before your very eyes, and you're deer in headlights going, oh my God, the whole banking system could collapse if I don't do something. And that's what every central banker is going to be facing, I think, sometime next year. And the only thing they can do then, God knows, you can't go to the Congress and say, can you come back with an answer in 2 days? Because I think if we don't do it in the next 2 days, we've lost our banking system. They couldn't come up with an answer in 6 months that they could agree on, right? Mm-hmm. So typically, anyway. So what you're going to have is the only thing that moves fast that can save a system is money, and they'll be reluctant. I mean, he's already talked about not wanting to do this again. That's part of the reason I think we're going to have a bust. Is they're going to try very hard not to repeat the mistakes of 2008-9, and in doing that, they're going to create the bust.
You just answered one of my key questions, because that is exactly it. Initially, I'd seen you on past interviews in the last month or two, and that's sort of where I disagreed with you. I thought, no, they'll bring in the calorie month 1, month 2, maybe month 3, but you just answered my question. So they're going to try so hard not to repeat the mistakes. No, let the economy weather the storm. We'll get through this, but and that's going to prolong it and actually lead to such a bigger collapse.
And keep in mind that this is going to be bigger than anything we've experienced. I mean, this could be, I think, likely will be the biggest financial crisis in the history of the world. So it's bigger than anything they've experienced. Now, they've had obviously something leading up to this and how fast they had to react to the pandemic.
It's like 2020 to 24. Okay, so you had this event come, right? Okay, they open up the spigots, $5 trillion. They got the economy back rolling. Okay, we're smooth. We've seen it get inflated and then bubble. It wasn't enough to destabilize the whole economy. We were able to kind of suffice it. The Fed's balance sheets come down from 9 to 6.9 trillion. But this next one that's coming, we've seen the scrimmage and the Super Bowl is on deck, basically. The same thing, but
it's the same playbook. And even though they swear that they have it under control and that that's why they're being so diligent, because they don't want to go back there and they think but it's those very actions of being careful and, not understanding the risks. As I say, I don't think the central bankers understand the magnitude of the risk behind this because of that leverage. And so they're sitting there saying, well, don't forget, they don't want to go back to printing like they did before. Think of all the criticism that Bernanke received and Powell's received about, and certainly the Austrian schools out there constantly saying we've got to do away with central bankers. They're idiots. So what, he's answering the critics and trying to listen to them and do what they say. He agrees. We don't, it's not a good thing to print money. And particularly not to throw money at a problem like that. Mm-hmm. So that's going to keep their hands, he's going to be sitting on his hands saying, well, I'm doing the right thing. And when I say it's not only are they not going to act fast enough, it's that when they do act, they're going to be too timid. In other words, they will. I fully expect early on in the unwind, you'll see them throw $1 trillion out there and he'll be unhappy that he has to do that, but he'll do it. But what does it take? How long will it take him to get to what I term right-sized policy? In other words, if it takes something close to 20 trillion to turn this thing, that's going to happen in many steps. They'll throw $1 trillion in and see it didn't stop anything. Then they'll throw 3 more trillion in and it didn't stop anything. And they'll throw another 5 trillion in and the thing's still free falling. And that could be over the course of weeks or it could be over the course of several months. But they're not, in fairness, nobody could, or most people couldn't see this, is they're not going to comprehend the magnitude of the money that's going to be required to turn the thing. And of course, the longer you wait, the more it's needed, right? Because the market's starting to implode and everything's happening. Yeah. And you've got a dominoing effect through pension funds. There's a lot of public pension funds that are going to be, they're already super underfunded and they're going to be so much more behind. So you're going to have a lot of that, the endowments, that are in the wrong places, in my opinion. You're going to see a lot of things out there that are going to start really unwinding. And of course, then, you've got involuntary liquidation in terms of bad loans in the banks, et cetera, commercial real estate. So there's going to be a lot of things happening. They're going to be conflicted because on the one hand, central bankers know they need to drop rates and cut rates and throw money at the problem. On the other hand, they really are determined not to go back to the policies that got us here. And part of that is the error is in not understanding. That's why I went back to the super cycle in the beginning of it. Part of the criticism that Wall Street is leveling on the Fed and on the central banks is misplaced. This is almost inevitable. It's what happens as you get to the end of the super cycle.
How was David Hunter preparing for this? First, you're telling us there's 30 to 40% further to run, but specifically the bust. Are you out of equities? Are you out of U.S. equities right now?
I will say this, that my belief is that you have not, I've said this on other broadcasts, you have to understand yourself. It's easy, and lots of institutional investors are doing this as well. They're saying, I got to start hedging. I guess this is getting crazy. The market's moved up so much and valuations are high. I'm going to get defensive here. I can't call the top. Nobody can call the top. I don't need to. I'm going to just start getting defensive. And I can promise you, because I think I know investor psychology better than anybody. I've been contrarian for my entire career. I can promise you at the top that if you get out now, you're going to be forced back in, or I won't say everybody will, but a lot of people will. the at the top, it will be very compelling to be in. You're going to say there's a long cycle ahead. The Fed's just beginning easing. There's no way this is the top. And look, if I stay out, look at the pressure on me, and my returns are going to fall way behind my competitors if you're institutional, and if you're an individual, you're just going to be, I'm missing out. So I tell people, be aware that we could be months away from a top, and yet from a return standpoint, basically 2 years away from a top. And so it's a quandary, because normally, you can call it within 3 months, particularly if it's a 42-year secular bull market top. If you can call it within a few months, you're doing damn well. However, if it's 25 or 30 or 40% premature, you're probably going to get out, regret it, and get back in. And then you're stuck then you're getting in at the top. So know yourself. That's first. What I do say is that the two assets that I think will hold up in the bust are Treasuries, because if rates are going to zero, obviously the Treasury bonds are going to do well. But Treasuries across the curve, because of the printing press, I have zero worry about, at least I'll talk about the U.S., but I have zero worry that the government is going to default on the bonds because they have a printing press. So, and I also have zero worry that the FDIC is not going to get whatever funding they need to cover the insurance liability. So you can be in savings up to the institutional limits, $250 per account or per institution. So those two things are ways where you're going to, those two assets will hold up in the bust. I think we're going to have the dollar fall here aggressively. So I have an 82 target on the dollar, which is crazy right now. Nobody believes that, but I think that's what we could see in the next 6 or 8 months. And on the other side, during the height of the bust, I think the dollar is going to get a bid, because it always is the place people run for safety. It's, our system has proven itself cycle to cycle. So I think you could see the dollar fall from, 106 now to 82, and then go back up to 120 in the bust. So the dollar, for those that can invest in dollars, the dollar could be another place to hide. But
post-bust, go ahead. Other than that, it's going to be a bloodbath.
Yeah.
Post-bust, I've heard some of your price targets and projections. I mean, gold, silver. Talk to us about some of the assets you think are going to perform the best once the printing presses start rolling.
Let me walk through gold and silver, because I don't want people to be confused. And because I have these big numbers, I get people confused. So my pre-bust targets for silver and gold are silver $75. So we're currently, $31 or $2 today after getting hit. So I think that can more than double here. Pre-bust means in the next 6 months or so. And gold, I see pre-bust 3,400. I had a 3,000 target, and I've raised it to 3,400. So and then in the bust, just like every other asset, they'll be hit. They won't be hit as hard as the stock market, I don't think. Silver could be, because it's more volatile. But as I say, if silver goes to 75, it could come back to 30 or even below that. If gold goes to 34, you might see it back to where it broke out at 2,100, that kind of thing. So it will get hit in the bust. And so people have to know that if you're going to buy and hold, just know the volatility you're going to be facing in that environment. And then on the other side of the bust, because of all the money printed, it's going to be a huge commodity cycle. So not just gold and silver, it'll be copper, it'll be, all the metals and steel and ag commodities, et cetera. But I predict that gold will go to 20,000 by the early 2030s. Silver will go to 500. Oil will go to $500 a barrel, and I think oil can go to $30 in the bust. So you can go from 30 to 500 in 5 or 6 years. So it's a one final blow off because of massive money. That's simply all it is. It's just, you get caught because and I tell people it's the easiest part of my prediction. The easiest thing I can predict, because it's human behavior, is that our policymakers, if faced with what I think is coming, there's no question what they will choose. If you have a choice between saying whatever the system does, I'm not doing anything, or I have the money available to save it, they may lag in their response, but they're ultimately going to choose to save the system. They're going to choose to print money and do whatever. They're not going to say, gee, if I print trillions of dollars here, 3 years from now, I'm going to be dealing with inflation. They're going to be saying, if I don't save the system now, I don't know where we're going, but it's not going to be good.
Yeah, we won't make it till lunch. And I think Japan having such a high debt to GDP ratio will give them a bit of a false sense, maybe that, oh, we're 120, we're 130. We can go to 230. What's the worst that could happen, right? Incredible stuff. I mean, so in the 30s, just to kind of bring it home, I mean, coming out the other side of this liquidity, interest rates go to the moon. I mean, that is going to be carnage. So at that point, you're forecasting somewhat of a Great Depression in the 2030s?
And I don't know. So this is all just kind of big picture stuff. But
of course,
I can foresee a possibility, and I'll just talk about the U.S., of 50% plus unemployment and a government bankrupt with either limited or no Social Security and Medicare and Medicaid, no unemployment benefits, no welfare system because they don't have the funding. They have no way to service it. So it'll either be a small fraction of what we do now, or it's going to be non-existent. So people are going to have to fend for themselves. I don't say this in any happy way. I don't say this to be provocative. I think there is no solution for what 80 years of doing things off the rails started out slow, but then has moved to this level. I just don't think there's any way to put the genie back in the bottle. And so, I mean, I can't envision. I can talk about numbers. I cannot envision.
Please do. Yeah, no, please do, David. Yeah. I mean, people have 5 or 6 years to potentially prepare.
But that's what I mean. The numbers are potentially 50% plus unemployment and, no unemployment benefits to backstop you, those kind of things. No health insurance, nothing. The system's broken. There's nowhere to go except self-reliance. So it's easy to talk about that. It's harder to envision that in terms of personal destruction is going to be, I think, tremendous. So,
will anything, obviously land, clean water, access to food, farming, things like that will do well. But I mean, in that stage, people will have turned away from the US dollar. And the whole economy will have to change to facilitate what you're describing.
Yeah, what comes out of the ashes, because it truly is, ashes, what comes out of that is hard to know. I hope it's not totalitarianism, but it could be. I hope it's, I know, those that want to talk about, crypto and talk about letting the system break and then rebuilding from there, starting fresh. I don't think know what they're talking about, because the risks, the pain in that break is going to be massive. And what comes out of that, who knows? And again, we're not even talking world wars or anything else. And again, this is global. I can talk about the U.S., but this is basically, I don't know where there are pockets that aren't like this. Everyone's
been playing the game. Everyone's been playing the debt game for too long. Is there anything that could change your outlook? Could something happen?
Yeah, I would say the one thing, and people want to grab onto this, and I go, I'm not changing my forecast, and I'm not saying I think it's likely, but the one hope we have is Trump, because basically he is coming in with at least he's talking right now, and he's putting the right people in place who believe in free market capitalism and reducing government to its much lesser state, and deregulating and taking advantage of the resources you have, and in our case, bringing our industry back on shore after we've given it away, and destroyed our middle class. That is the hope, is that the next 4 years, and particularly the 26 to 30 period, that there's enough there that we get huge productivity enhancement and things that can head off the inflation to the extent. But what I keep saying is the macro seems to trump Trump. In other words, if you do 20 trillion in money, it's hard for me to see where any policy can offset that, because of the inflationary implications.
Trump and Powell have had their little war of words, right? They've had a few spats back and forth. Is there a chance that he appoints someone different before the bust, and that person has the conviction to not print $20 trillion and to avoid the further bust and go through, and it's still an extreme amount of pain and hardship, but, to stop short there and ultimately save America?
Two things. Yeah, and it'd probably be, I can't remember her name, but she's, the one that would probably want us going back on a gold standard and certainly having discipline in the Fed. The problem is, if that had taken place in 2019 or 2020 before the pandemic, we'd have a real chance to have said we got religion, we got discipline, and we're able. It's going to be painful, but we're able to do it. Where we're at now, I think that would make things worse. In other words, with the kind of debt that we have in the system right now, and don't forget this, if it's a bust or an unwind, it's global.
Right.
I think a lot more of the risk is over in Europe, and maybe some up your way. As I say, our banks got some religion after 2008-9 because they had to. They get legislated. Your banks almost didn't. Your banks were in great shape then, and they've made the mistake and not learned from our mistake, and now they're real estate, and I don't think they're quite as bad as we were then, but they aren't in great shape this time around. So, and Australia's got their real estate problem is through the roof, and their leverage. So I think Asia, Australia, Canada, Europe are all in worse shape than our banks now. But our banks are it's a small world, so our banks are not immune from this. It's going to be just dominoing across the world, in my opinion. But there's little hopes here and there that it's not as dire as I portray. I mean, certainly right now, people don't really believe my bust scenario now because things look like we're going to have a soft landing or no landing or whatever. But I just think under the surface, the signs are there that we're going to run into trouble here in 2025.
David, where can our investors follow your work?
Sure. I'm on Twitter or X pretty much every day, replying to questions and comments. So my handle is at Dave H. Contrarian, not David, but Dave H. Contrarian. And I also put out a quarterly macro letter that is by subscription, so there's a cost to it. If people have any interest in that, they can direct message me on X, and I'll provide details.
David, I can't thank you enough for coming on, sharing your wisdom with us, sharing some of those insights and those forecasts. I hope you're wrong.
Me too.
For some of them. We'll see what Trump can do here as he takes office in January. And it was a pleasure. It was an honor to have you on, and hope to see you again.
Yeah, thanks, Alex. Enjoyed it.